Donald Trump thinks he's holding a royal flush. He's got a busted inside straight, right? He's drawing. He's never going to fill it. He's got nothing. He's got, China's got the cards. Besson says, "Oh, we're the deficit nation." Yes, we are the deficit nation. That's our problem. They say that China wants what we have. What do we have? A printing press? They got a printing press. We want what they have. The products that their factories produce. They've got the stuff. And if you produce it, you can consume it. We can't consume what we don't produce, right? There's more of them than there are of us. There's triple the population. There's almost 1 billion or maybe 1 billion people in China. We got like 340 million.
You're watching Capital Cause, and my name is Danny. Today's guest is the legendary Peter Schiff. Peter, thank you so much for coming back on the show, my friend.
Oh, thanks a lot for having me back on again.
Yeah, for sure. Lots of stuff going on. I mean, this is, you and I was joking about it before we hit record, but this is the Super Bowl, Peter. This is our Super Bowl, essentially. If it does, if we are in the midst of it or the very beginnings of it, this big market crash. But what's your overall take? I think you have a more nuanced take on it, but how do you view what's going on, what we saw transpire last week?
Well, I don't want to necessarily describe it as a Super Bowl, and that, the Super Bowl is, a fun thing, a celebration. It's not really that I want to celebrate the fact that I think we're going to have an economic crisis. I mean, it's something that I've been predicting for a long time, and it hasn't even totally happened yet. So it's even premature to really say I told you so. But I'm not necessarily going to celebrate the fact that I was right. I want to be right, although in a way I want to be wrong. I mean, if I'm wrong, then the U.S. is not in nearly as much trouble as I thought it was. I mean, so it's always nice to be right, but it's not something that I want to celebrate, because a lot of people are going to lose a lot of money. A lot of people are going to get wiped out. A lot of people's retirement plans are going to be shattered. And so it's not necessarily, a Super Bowl, although, there's always people that are disappointed because their team loses the Super Bowl. But they still probably enjoy the game. Not that many people are going to enjoy what I think is going to happen at the end of this. It's not happening yet, but I think that we've set into motion the forces that will ultimately produce a sovereign debt and U.S. dollar crisis. Powell said again yesterday, or, he talked, and he said, we're on an unsustainable path. He said the debt is not unsustainable, just the path, which I think is BS, because if the path is unsustainable, then the debt is unsustainable, because that's the path the debt is on, and it's not changing. The path is the path. If anything, we're picking up the pace. So whatever path we're on, we're going to get to the destination even faster because of the increasing debt.
And you said you don't anticipate, we don't know whether or not we have actually begun seeing this economic crisis begin, but from what we've seen transpire last week, what do you make of this? Is this could we see another blow off top, so to speak, another run up to new all-time highs from here?
Oh, in the stock market? I don't know. I mean, I think I think it's less likely than not that we're going to make new highs, because the market was very expensive before the trade war. And so now that we have the uncertainty of how it's going to play out, that's less reason to want to pay those prices. I mean, the market was priced for beyond perfection. And what we have now isn't even close to perfect conditions for any market, let alone a market that's still as overpriced as the U.S. stock market. But what I think is significant about what's happening is that we've begun the exodus out of U.S. financial assets, where the U.S. dollar is no longer the primary reserve, and our trading partners are not recycling their trade surpluses into U.S. financial assets. Donald Trump has made it clear that a goal of his presidency is lower trade deficits. And the only way that's going to happen is if Americans import less. And since we don't have the capacity to produce more, we're not going to close the hole with exports. It's going to be with lower consumption and a weaker U.S. economy, and more of our inflation is going to stay within our own borders. We're not going to be exporting it to the rest of the world, who is then going to recycle it into our bond markets and into our stock markets. So I think we've reversed this, benevolent cycle, and only benevolent in the sense that in the short run, we benefited while sacrificing our future. But that's going to be reversed. We're not going to be able to enjoy that global subsidy and live beyond our means. And so that means Americans are going to have a lower standard of living because consumer goods will be less plentiful and more expensive, and interest rates will be higher, and the stock market will be lower. So things are going to be tough here, but I think we're going to have a real economic boom outside the United States as they're liberated from the burden of propping up our economy. So that's really who Trump liberated on Liberation Day. He didn't liberate Americans. He liberated the world from having to support Americans.
Is that what we saw when we had the market correcting, stock market correcting, but also at the same time, bonds are pretty much retained their positioning? They're still at this 4.3, 4.4% bond yields, that is 4.4% level. But then you also saw the DXY come down below 100.
Yeah, that was the opposite of what all the experts were forecasting. Of course, it's exactly what I had been forecasting. But this really evidences that I was right, not just because I got the forecast right, but because of why I got it right. And so what's really happening is the world is fleeing U.S. assets, not, embracing them. Donald Trump and his advisors said that the tariffs would cause money to come into the country because everybody would want to invest their money in America to avoid the tariffs. The opposite has been the effect. It's caused people to sell U.S. assets and bring their money home. And so the dollar index dropped precipitously. It's about 10% off its January high, about 6% decline since Liberation Day. The Swiss franc has moved to a 14-year high, within 3 or 4% of an all-time record high, and the euro and the British pound moved to 3-year highs against the dollar. And the Japanese yen had a big run as well. It's not a 3-year high, I forget, because the yen had gotten clobbered. It got all the way down to 160 at one point, and now it's back around 142. So it's really climbing, out of the hole that it was in. But this really showed that there was no flight to the U.S. dollar. There was no flight to treasuries. And foreigners got killed on their U.S. treasuries because A, treasuries didn't rally, and B, the dollar got killed. So they're measuring returns from the perspective of their own currencies. And so they have a big hit. And the U.S. stock market went down dramatically for foreigners. So I think foreigners are pulling out of U.S. stocks and bringing their money home, where the valuations are far more attractive, lower PEs, higher dividend yields, and they don't have to take the currency risk, which is, eviscerating the returns from foreigners. And of course, eventually Americans are going to start to notice how much better foreign stocks are doing, and they're going to want to get in on the action. So they're going to want to sell their U.S. stocks and invest abroad.
If you're forcing the world to pick between ourselves and China, this is what Donald Trump has said the other day, and that is to anyone that does business with China, or anyone that closes off China, they'll see some reduction in their tariffs.
Yeah, I think that's a bad strategy, because I think it'll backfire, because, a lot of countries, first of all, have trade surpluses with China right now. So they're they're earning money that they're then using to buy stuff from other countries, right? So they have valuable relationships. Plus, the stuff they're getting from China is stuff that their consumers really need, and they get a great deal from China. So basically, you're asking countries to pick between Chinese goods and American treasury bonds, because that's what we've got to offer, right? Keep buying our treasury bonds, keep loaning us money, or keep getting all these goods that the Chinese are giving you. So I think most countries are going to pick China. China is the more important market. All we've got is consumers. But if our consumers won't buy, then they'll sell to other consumers. Because remember that the whole purpose of exporting is to pay for your imports. It's not to load up on treasury bonds. And so China's got more stuff that other countries want to import. Look how much we import from China. And so if we cut off China, we lose.
Yeah, I'm glad you mentioned the trade surpluses all these other countries have, not just with us, but also with China. And yet that doesn't deter China from trading with them and so forth. So the question is, I mean, if the United States trying to manage their deficits between countries like themselves and places like Vietnam and other third world countries, places that are making where the average person makes like $500 a month. I mean, can you realistically expect countries like that to have an equal playing field in regards to trade to begin with?
Look, first of all, the whole idea that the playing field is rigged and stacked against the U.S. is just not true. And all you have to do, again, look at China. A lot of countries have trade surpluses with China. If China was cheating, nobody would have a surplus. I mean, why do all these other countries have no problems overcoming the same supposed barriers that we can overcome? And also, we have a trade surplus with China in services. Why aren't they cheating there? Why aren't they keeping our services out of China, right? If they're determined to screw us over, right? Why aren't they screwing us over on services? It's all BS. Other countries could say, "Oh, America, you have to reduce your services surplus. You're not buying enough of our services. We're buying too many of your services." Look, it's all comparative advantage, and none of it is orchestrated by government. We don't trade with governments. It's not the Chinese government trading with the U.S. government. It's individual Americans deciding what they want to buy, where they're getting the best deal. And that's happening in China, right? Chinese people are deciding what products they want to buy and what services they want to buy. They're buying a lot of our services. They're not buying a lot of our products, but neither are we. We're not buying our products either. That's the problem, because we don't produce them. And so what Trump wants to do is just reduce individuals' choice. He wants to force Americans to buy fewer foreign products, even though that's where they're getting the best deal. So it's not a good thing when the government tries to limit your choices. The more freedom we have, the more prosperous we're going to be. And, if Trump wants to limit the freedom of Americans, other countries shouldn't follow our lead and try to place similar limitations on their own citizens.
Peter, what do you make of it when people say things along the lines of, well, this is Trump weaponizing the U.S. consumer base, the preeminent consumer base of the world? Is that not an effective strategy?
No. That's our vulnerability, because our consumers are not producers. What's supposed to enable consumption is production. Our consumers just spend dollars that they get. The Fed creates it, out of thin air.
you're looking for great deals on gold and silver coins and bars from a company that you can trust, then you've got to check out the good folks over at Pimbex. This year, I've really gotten to know these guys, and all I can say is you're not going to deal with a better group of people. They're a family-owned gold and silver online bullion company offering the essentials and more at industry-leading prices while always providing first-class top-tier service. That's PIMBEX.com. And if you're looking to convert some or all of your retirement account into real gold and silver, give Pimbex a call. They'll help explain the process and get you started on the right path. Your support at Pimbex also helps support the channel. So reach out to Pimbex today. You won't be disappointed. And make sure to tell them Danny sent you.
So our strength is actually our vulnerability. Donald Trump thinks he's holding a royal flush. He's got a busted inside straight, right? He's never going to fill it. He's got nothing. He's got, China's got the cards. Besson says, "Oh, we're the deficit nation." Yes, we are the deficit nation. That's our problem. They say that China wants what we have. What do we have? A printing press? They got a printing press. We want what they have. The products that their factories produce. They've got the stuff. And if you produce it, you can consume it. We can't consume what we don't produce, right? There's more of them than there are of us. There's triple the population. There's almost 1 billion or maybe 1 billion people in China. We got like 340 million. There's no shortage of consumers in China. They got plenty of consumers. What we have a shortage of is factories and supply chains and skilled workers. That's a big problem. They don't have a problem finding consumers for their stuff. Anybody will consume, right? And the way to do that is weaken the dollar and strengthen the yuan. So China can kill two birds with one stone. Dump their dollars, dump their treasuries, dump their U.S. corporate bonds and whatever dollar-denominated debt they have, buy gold, right? So diversify out of the dollar, peg their currency to gold. The yuan goes way up, and now all the Chinese are enriched. All the Chinese now have a huge purchasing power. They could buy all the goods that they were shipping to us, and we're the losers, right? They just take our purchasing power. Now China's got all the wealthy consumers. We just got a bunch of paper that nobody wants.
Do you think we can ever roll this back? Because I've heard this analogy, and that is, it's kind of like when you break a vase and then you try to glue the vase back together. Like, sure, you putting the pieces back together, but it's still the foundation is no longer what it used to be. Can relations with America and China recover after something like this?
Well, I think it's difficult. I mean, I think Trump is going to try to dig himself out of this hole by kind of pretending that this is all part of his master plan and it's all going exactly the way he planned it in his 4D chess game that nobody else can understand because he is the greatest negotiator in the world. And none of us can really understand the method of his madness because that's how, smart he is. But I think they will announce some deals, with various countries that they will tout as being this major win, but, they'll really be insignificant, just cosmetic victories to the extent that, the U.S. and countries reduce whatever trade barriers they have. Yes. I mean, that would be a good thing, but not enough to move the needle on the U.S. trade deficits because that's not why we have them. But, I do think that we've kind of started a process that is going to take on a life of its own. And as the dollar weakens, it will continue to weaken because currencies tend to trend. As, the U.S., the foreign markets are outperforming, that will continue. For years, it's been obvious to pretty much any, investment portfolio manager that Europe and Asia had better valuations, that stocks were a better deal than they are in the U.S., that you were getting a lot more earnings and dividends for your money. But as long as the U.S. market had the momentum, that was kind of secondary. Valuation didn't really matter. because what mattered was U.S. stocks go up. And, so we want to own them because they're going up. But once that turns and momentum is no longer the driving factor, now the valuation disparity becomes much more significant. And so I think we've already started the reversal of flows out of U.S. stocks and bonds into foreign and out of the dollar. And so I don't know that you could reverse that, given how overvalued U.S. stocks are still compared to the rest of the world. And once the dollar really starts to fall, that is a giant relief for the world, especially the emerging markets. The emerging markets have really been hampered by a strong dollar because that has kept capital out of the countries. But a lot of the emerging market companies have dollar debt. They borrow in dollars, but they collect revenue in other currencies. And so that's been a strain on their income. It's been a negative. It's inflationary in their countries. If their currencies are weak, puts upward pressure on their local interest rates. But when the dollar really starts to fall, that's a home run for the emerging market. So, this can really, change the momentum of capital flows in a way that we can't reverse. And then eventually, we're going to have a crisis because interest rates are going to blow up in the U.S. The debts are going to blow up. We're not going to be able to finance our debts. The government's going to be back to QE, the Fed rather, and inflation is going to be running rampant. So we have a lot of problems on the horizon that are going to come together to create a massive crisis.
Yeah, I have the S&P divided by the World Stock Index here. We can take a look at it really quick. And this is on the monthly candlestick. And you'll notice that, the S&P has been outperforming the world stock market for almost, 15, 16 years now. But the last few months, several months, you've seen these three big red candlesticks, and we've just dipped below the 20-month moving average here. So it looks
Now,
like
are those returns all U.S. dollarized? So do they take into account the movement of exchange rates?
I don't think so. It's just the S&P. It's just the S&P divided by the world stock market.
Right. What you really have to do is do the chart in U.S. dollars, because then it's an even bigger, move up for the U.S. Right, because
right.
But then also it's a much bigger reversal, so it looks like an even bigger turn.
That's a good point.
Than what you see if you're not factoring in the currency, because the currencies are a big part of the equation. Because when the dollar is strong, that makes the return on U.S. stocks that much greater when Europeans are looking at them, and so it makes it more attractive. And the
magnifying force, yeah.
Here, when the dollar is weak, that means European returns are that much greater for us when we look at it, right? Because while our base currency is the dollar, we price everything in dollars. If you're in Europe, you look at your brokerage statement in euros every month. Mm-hmm. And so you're looking at the euro price of U.S. stocks, not the dollar price. And we look at the dollar price of European stocks. We don't care about the euro price, right? We just care about the dollar price. So if the dollar goes down 20% against the euro, even if European stocks are down 5%, Americans are happy campers because they look at their account and it's up 15%, right? That's what they see.
Yeah. And then I also have another ratio chart for you to look at. And this is the gold to silver ratio. I think we looked at it before we hit record, but I want to show the audience this as well. And so you've got some pretty historic movement in the gold to silver ratio here. So anytime this chart goes higher, that means gold is outperforming silver. And you'll notice this chart goes all the way back to 1975. And we've never been at this level before, aside from two separate occasions. Number one, 1990. This is 1990, and then during the COVID crash. But you'll notice that we the wick on this candlestick, I believe this was probably yesterday's price action when gold hit about 33.50 and silver was still around $32. That led to a gold to silver ratio about 108 to 1. But nonetheless, I mean, this level hasn't been hit on except for one occasion. That is COVID. So what do you make of this gold to silver ratio? What does this imply?
Well, again, it's not just gold, silver, because look at the oil price. Put up a chart of oil. Oil's never been this cheap other than, COVID for a couple of months, which is a complete aberration because they were giving oil away because it went negative. But oil's never been this cheap. But look at platinum, look at palladium, look at the other precious metals.
Yep.
They've never been this cheap either.
Yeah. Well, and oil, I mean, oil isn't in this chart. It's not even inflation adjusted.
Yeah, right? I mean, I can't really see the chart because where the lights are and how far away it is from me. But yeah, and I think that's because you've had a lot of central bank buying of gold, and you haven't had central bank buying of those other commodities. But I do think the other commodities are going to turn because they're just very cheap. I don't think gold is expensive. I think those other commodities are cheap. And so I think that the way this is going to mean revert is going to be with the other metals coming up more than gold. I think gold's going to keep rising, but I do think you'll get a bigger rise out of silver, probably out of platinum as well. At some point, these metals are going to move. I just don't know when it's going to happen, but it will happen, right? And oil is going to go up and agricultural commodities. I think that, maybe the big drop in the dollar is going to be the catalyst for the big boom in commodity prices and those commodities, catching up to gold. They're not going to catch it in a sense that they're going to, silver's not going to be the same as gold price, but it's not going to be 100 to 1. It could go back up to 30 to 1. And at 30 to 1, that means, silver has to triple even if gold just stays where it is. But of course, gold's not going to stay where it is. So getting to 30 to 1 is going to be a moving target.
And what do you make of, in addition to investors not fleeing, but on a relative basis, leaving the dollar, as we saw last week, gold was able to maintain its price level fairly consistently. We did have an episode where it kind of dipped below 3,000, but relative to everything else, it held up fairly strong. And then fast forward a week later, we're back to making new all-time highs. Is this the beginning stages of where investors begin to see gold as the true safe haven play as opposed to the USD?
Yeah, gold, it had one dip below 3,000 and then it made a new high. I think the record I saw was above 3,360. And that was last night. It made a new record. It's pulled back a little bit now, but it's still, it's still above 3,300. So we're 10% above 3,000. I think it's becoming clear to people who didn't see it before that gold is the new safe haven. It's always been a safe haven, but it's the last one standing. Treasuries were thought to be a safe haven, but I always pointed out they weren't a safe haven because they don't provide safety from inflation. And that's a big risk. And the gold provides that. And there were a lot of people over the last couple of years that were misled to believe that Bitcoin was an alternative safe haven to gold, that it was a digital cousin to gold, right? It even better because gold was analog and Bitcoin was digital gold. And, digital is better than analog. But I think now people are finding out, many are still reluctant to admit this, but they will eventually have to acknowledge this, that Bitcoin is not an alternative to gold if your goal is a safe haven or a store of value or an inflation hedge. Bitcoin can be looked at as an alternative to buying a lottery ticket, or buying a penny stock, right, that has no earnings, right? So, it's a way to gamble on something happening, but that's risk. So when you buy Bitcoin, you are assuming risk, right? If you sell stocks and buy Bitcoin, you're going from one risk asset to an even riskier asset. If you sell your stocks and buy gold, that's a completely different story. That's de-risking, right? That's going to something that's safe or stable, and so people are starting to realize that what they thought were safe havens are not safe havens. And so buyers of treasuries are buying gold instead. And maybe buyers of Bitcoin are buying gold instead.
It's interesting because we've had, by my count, about 3 separate occasions of a dry run with a small episode of corrections. Number 1 was last week. Number 2 was the yen carry trade from August of last year, and then of course you also had COVID, which is much larger of a correction than what we've seen here in recent times. But in each of these 3 episodes, you'll notice that yes, gold did come down, but it came down the least amongst its peers. And then you also start to notice
that's what always happens. Like, even if you go back to the 2008 financial crisis, gold dropped almost 30% from peak to trough, but the stock market was down 50%. So you still lost less in gold. You could still buy more stocks with your gold. And of course, there were individual stocks that were down a lot more than 50%. So depending on what you own, I'm talking about the S&P was down like 50%, the Dow. There were stocks that were down 70, 80, 90%. There were stocks that went bankrupt right during the 2008 financial crisis. So gold was a safe haven, even though it went down. But now gold's not even going down. I mean, gold dropped in COVID too initially, but not that much, not as much as it did in 08. And gold made a new high long before the S&P made a new high, because gold, the pre-2008 financial crisis high for gold was 1,000. Then it pulled back to the low 700s, 2008. And then it rallied to 1,900 by 2011. So it was almost double its pre-2008 high. The stock market didn't come close to even recovering its 2000 highs in 2011. So gold went down the least and up the most. Same thing happened with COVID. Down the least, recovered the most. And we've already seen that in the Liberation Day mini crisis. Gold went down less than the market and then soared to a new all-time record high. And the same thing happened with gold stocks. Gold stocks initially went down more than the S&P. Just like gold stocks during the early days of COVID shutdown, gold stocks went down more than the S&P, but then soared to much higher than they were pre-COVID. That took a while for. And so here we had gold stocks immediately drop more than the NASDAQ even. But then they zoomed and made new 52-week highs. Many of them made multi-year highs. But, the gold stocks, that's another chart you should look at, is the miners, a long-term chart of like a GDX or GDXJ in particular versus bullion. And look at those charts, because that's where I think the most value is. In fact, I just got a special report that I wrote about a month ago. It's called The Best Way to Buy Gold. You can get a copy for free on my website at europac.com. But right now, the best way to buy gold is not to buy gold coins or gold bars. Buy shares of gold mining stocks, because there you're buying gold that's still in the ground. You still own the gold. You're a shareholder of a gold mine, so you own a fractional interest in that gold. It's just still in the ground. But gold in the ground has never been this cheap relative to the gold above the ground. And so that is, I think, for now, the greatest investment opportunity, speculative opportunity out there, is to buy these gold mining companies.
Yeah, I've got the GDX relative to the gold price. And I mean, it's like you said, pretty much we've been in this basing out pattern for quite a while now. You've got this, I don't know if you can see it, but we've got this L-shaped form from 2007 up until today. So, and then to kind of add fuel to the fire, you also have a fairly subdued oil price in the midst of the rising gold price. So
that's part of the fundamental story. And it's not just oil, but there's 2 big costs if you operate a gold mine, other than maybe you have to pay some royalties or permits, stuff like that. But the 2 major variable costs to your mine are energy and labor. And oil right now collapsed. Right before Liberation Day, it was $71. And now, even after today's $2 rally, it's still below 64. So gold's gone way up, oil's gone way down. That's great if you have to buy oil to make gold. So that's great for the margins of gold companies. But also, we mentioned that the dollar has gone down against the euro and the pound and the Swiss franc and the yen. But there are no gold mines in Japan. There's no gold mines in Switzerland. The gold mines are in Australia. They're in Canada. Those currencies have gone down against the dollar since Liberation Day. So the wages, if I'm a mine operating in Australia, my oil costs have gone down, even in Australian dollars, but my oil costs have gone down, and I'm paying my workers less in relation to what I'm getting selling my gold in dollars, because gold is sold on the global markets in US dollars, not in Australian dollars. And so profits are going to soar. I mean, all these gold companies are going to report really good profits for Q4 of last year, but they're going to have blowout numbers for Q1 of this year. I mean, Q2 of this year. Q4, they already reported. And those were great numbers, but some of them weren't as good as people hoped. And so a lot of the stocks kind of sold off on their earnings. But I think that the Q1 earnings should pretty much beat across the board. But Q2 should be blowout because of the big spike in gold and the drop in mining costs.
Yeah, so I've got the gold to oil ratio here, and now I'm going to juxtapose the GDX price in whites. And what you'll notice is that it's like you said, again, the GDX price pretty much tracks the gold to oil ratio, and both of these are on the upside. I mean, if the GDX price keeps following the gold to oil ratio, then it portends to a much higher GDX price.
Yeah. And to the extent that we can produce more oil, Trump wants us to make more oil. That's great for the gold mining industry because they can buy that oil. They need it.
Right. Well, I think that's pretty much all I have on the table here, Peter. Anything else you want to talk about that we didn't get into?
Look, I just think people should, recognize what's happening, and don't be a deer in the headlight. Do something, make some moves that will allow you to be positioned to profit from this global realignment. This is a major capital movement out of overpriced U.S. financial assets and the U.S. dollar into undervalued foreign assets, foreign currencies. That includes moving out of paper into real things like commodities, moving out of even developed markets. That's another chart you could look at, is the developed markets versus the emerging markets. Emerging markets right now are extremely cheap on a historic basis compared to their developed peers. And so I think a lot of these trades are going to mean revert. A lot of people are going to start, reallocating for the trends of the future, and they're going to bail out of the trends from the past. But the problem is most people don't recognize the shift. They stay with the old paradigm too long. A lot of people stayed with the Nifty 50 throughout all the 1970s, and they got crushed. They didn't realize that the game of the 50s and 60s didn't work in the stagflation decade of the 70s. But if you held on to, your Polaroid stock and your Xerox stock, you got decimated in the 70s. Not only did you lose money because the stocks went way down, but inflation went way up. So prices went up while your stocks went way down. But if you were smart in the early 70s and you bought gold, you bought oil went from $3 a barrel to $30 a barrel. Pretty big move. So you made a lot of money in commodities in the 70s. Gold went from 35 to 800. But you cleaned up if you bought Japanese stocks or, Europe, German stocks, Swiss stocks. Foreign stocks killed it in the decade of the 70s. But most Americans didn't realize that, they were just, they were so conditioned to buy the dip, and that's what was ingrained in their psyche. Oh, it'll come back. I don't want to sell these stocks. So you're going to have a lot of Americans that are just sitting in a Mag 7 or other stocks or cryptocurrencies or Bitcoin, thinking, well, I'm going to hold, right? Because it's always come back. Well, it always comes back until it doesn't. And people overstay the party and don't realize that there's another party that they can join that is just getting going. And that's the one in foreign stocks, commodities, gold. And so people should make the move. If you want some help, we can help you at Euro Pacific Asset Management. You can talk to my representatives there, get an account open. If you're more of a do-it-yourselfer, you can buy my funds, no load. I'm looking at my dividend payer fund, and you can get information on all these funds on my website. But my dividend payer fund, foreign dividend payer fund, is up better than 20% year to date. This isn't a gold fund. This is a fund of, undervalued stocks in Europe and Asia that's up 20% year to date, right? This is the best year this fund has had since I started it, and we're only 4 months into the year. So what does that tell you? And, we had record outflows out of my fund in the fourth quarter of last year. So just before the best quarter in the history of the fund, clients were pulling their money out because, they were tired of waiting for the foreign stocks to start to do well. And when Trump was elected, they were like, oh, yeah, this is going to be great for U.S. stocks. And I kept telling people, I don't think so. The U.S. stocks were an accident waiting to happen. And Trump provided it. So, that's a good return. And we're actually number one in our category. Morningstar tracks 370 funds year to date, and we're number one year to date in the foreign large cap value category. But you can buy that fund no load. My gold fund has actually been underperforming its peers, and but that's not going to be a problem because you have to understand why it's underperformed. So we have built really large positions in small cap gold mining companies that are very hard to buy. They're not that liquid. And if you tried to buy them, you'd really goose the price. But the small ones haven't really moved yet. This first leg, the money's gone into the big miners. And we own some of those too. That's why the fund is still way up on the year. But we have an overweighting in these small companies. That's been a drag on performance. But once a lot of money really comes into the sector, and now people want to broaden out and go for these little companies, which have a lot more leverage than the big companies, these things are going to take off. So I think my gold fund is going to go from near the bottom of the pack to the top of the pack. So the key is buy it before that happens. Buy it, don't wait for it to be number one. You want to own it on the way to number one so that you get those returns that drove that performance. So, and you can buy that one no load too. The symbol is EPGIX. You can buy Schwab, Fidelity, anywhere, or, we have separately managed accounts as well that we do at Euro Pacific Asset Management. So you could talk about it with my representatives. And if you don't have a brokerage account and you're a small investor, you can actually buy shares right on my website, on the Europac.com website. So, make sure you get involved, do something about this, and, listen to my podcasts, follow me on X. I'm putting out a lot of good comments. I'm following the news and I'm reporting the truth because the mainstream media just gives you spin or bias, either from the left or the right. Nobody really calls a spade anymore. Everybody's got, a horse in the race and their horse can do no wrong and the others can do no right, so they don't really tell it like it is.
Yeah, there's derangement syndrome on both sides. So, Peter, thank you so much for coming on, my friend. We'll have the link to Euro Pacific Capital down below. Be sure to check it out, guys. We'll also have
asset management. Yeah, Capital was my old company. I sold that one a long time ago.
Okay, Euro Pacific Asset Management. Sorry about that.
Yeah,
link is down below. Be sure to check it out, guys. We'll also have the links to your X and the rest of your social media down below as well. So, if people want to follow you on any of your social media, the links will be down there. Guys, thank you so much for watching. It's been a great episode. If you agreed with Peter's takes, write go, Peter, go in the comments section. Drop us a like. Comment down below if you agreed or disagreed. If you disagreed, that's fine too. Let me know why. I do read the comments. And subscribe to the channel so you don't miss an episode. It also helps us grow in a very small but meaningful way. So also, finally, check us out on capitalcosm.substack.com, our Substack where we post all of our episodes early and ad-free, so you don't have to suffer through the YouTube ads, as well as uncensored for the interviews that warrant it. And so with all that said, thank you guys for watching, and I will see you in the next episode. Bye, y'all.
Bye-bye.